Every single second, the modern investor is bombarded with a chaotic, overwhelming stream of raw, unfiltered financial data. To the untrained eye, a standard screener is nothing but a wall of static. Professionals know how to extract a distinct narrative from that noise. Take a look at this financial dashboard for Senores Pharmaceuticals Ltd. At a glance, we are dealing with 16 distinct metrics competing for attention on a single screen. This specific layout presents a highly contradictory set of facts. It is exactly the kind of profile that traps novice analysts. Understanding Senores means systematically pitting these conflicting numbers against one another to reveal exactly what the market is betting on. We need to anchor our analysis by establishing the company's current market reality, starting with the absolute baseline price tag. Right now, a single share of this business trades at 862 rupees. A share price alone tells us nothing until we understand the size of the entire enterprise. For that, we look at the total market capitalization, the exact price tag to buy the entire company outright today, which sits at 3,971 crore. How does a pharmaceutical company justify a nearly 4,000 crore valuation? We look at its raw earnings power. The profit after tax over the last year was 102 crore. There is a massive gulf between earning 102 crore and a valuation of almost 4,000 crore. To see why investors accept that gap, we have to investigate the valuation multiples. We transition from absolute size to relative valuation using the market's ultimate measuring stick, the price-to-earnings, or PE ratio. Senores carries a stock PE of 39.1. This means investors are currently paying 39 rupees for every single rupee of current earnings. But that multiple requires a benchmark to be useful. Down here, we see the industry PE sits at 29.4. Senores is trading at a roughly 33% premium over its direct competitors. What compels the market to pay a 33% markup for this specific asset? The market does not hand out a 39 multiple by accident. It demands hard evidence of extraordinary future expectations. To find the justification for that premium, we have to examine the company's historical performance. We see a staggeringly high multi-year revenue expansion, with 3-year sales growth hitting 204%. Tripling top-line sales is an achievement, but it only matters if that cash translates to the bottom line. The profit variance over that same 3-year period is even more aggressive, coming in at 290%. A rigorous analyst should immediately ask, is this growth a thing of the past, or is it still happening right now? The latest quarterly metrics prove the momentum holds. Sales are up 69.4% and profits are up 84.3% year over year. Together, these 4 metrics paint a clear profile. This is a hyper-growth engine firing on all cylinders. This explosive, sustained triple-digit trajectory is exactly why the market feels confident paying that 39.1 premium. This is where our investigation pivots. Novice analysts stop at the growth metrics and buy in. Professionals look for the cost of that growth. We measure that cost using Return on Capital Employed, or ROCE. It tracks the true internal efficiency of the company's engine. Looking at Senores, the ROCE is 11.4. The company is generating massive profit growth in absolute terms, but it is not highly efficient at compounding capital internally. This suggests they have to deploy massive amounts of new capital or rely on sheer sales volume to hit those numbers, rather than enjoying high-margin pricing power. This exposes the core friction of Senores Pharmaceuticals. You have an explosive growth trajectory powered by an inherently average, inefficient internal engine. If they are deploying capital inefficiently to fuel this growth, we have to ask, are they borrowing dangerously to fund it? We check the debt load, which sits at 241 crore. Against a market cap of nearly 4,000 crore, that debt is minimal. The growth is not being driven by reckless leverage. We then look at who holds the remaining risk by checking the promoter holding, which is at 45.8%. With nearly half the ownership retained by insiders, the founders have massive skin in the game. That provides a solid layer of foundational stability. The risk profile here isn't an impending bankruptcy or a debt spiral. The entire risk rests on whether that 39 PE multiple is simply too high. We pull back from the individual metrics to view the entire board one last time, building our final mental model. On one side of the scale, we place the bullish evidence. the 200% hypergrowth, and a safe, low-leverage capital structure. On the opposing side, we place the bearish counterweights, the expensive 39 premium multiple, and the sluggish 11% efficiency drag. The current market thesis assumes the sheer velocity of the sales expansion will continually outrun the drag of poor capital efficiency. In a scenario like this, perfection is already priced in. Any stumble in that quarterly profit variance will cause the multiple to collapse violently. Screening for raw profit growth alone is exactly how amateurs get caught out. High growth figures do not exist in a vacuum. A professional analyst always synthesizes growth against the strict reality of the valuation multiple and the constraints of the underlying return ratios. True equity health resides in the tense balance of the entire financial dashboard.